So, Constance, one of my questions is, how much can the market withstand even some really bad news on trade? That is because there are other things that are going well, particularly the U.S. economy. It is going well overall, so can that support the markets essentially?
Yeah, so we're obviously at the late stage of this expansion, and the real question, absent everything that's going on with trade, is how long can this expansion continue, right? And we're sort of in a sweet spot. I mean, we have low inflation, which I think will get confirmed later this morning. We have very low unemployment and 103 consecutive months of jobs growth. We saw productivity pick up in the first quarter. So those are all things that augur very well for an elongated expansion, right? But with that said, we're not growing at a really robust rate because our potential GDP is relatively low. And so we're vulnerable to shocks, either of our own making or external. And so getting back to Mark's point, is this posturing or structural? There is a real structural difference between the way China thinks that an economy should be run and the way the U.S. and, by the way, most of our OECD counterparts and many emerging market counterparts think an economy should be run. And so there is this fundamental structural problem that underlies and underpins this whole process that I think is at the root of the problems.
Although I think that the one thing that's buoying the stock markets globally is this faith in themselves, this idea that they're the ultimate check on the Federal Reserve and President Trump. President Trump this morning tweeting about 401ks and how well they've done since he took office. And then the Federal Reserve, a lot of people think, capitulating to the market, a little bit of turbulence by pulling back and putting any further rate hikes on hold. So, Mark, how much power do markets have to kind of keep some of these tensions and a potential rate hike in check?
Yeah, I'm glad you bring that up, Lisa, because my comment earlier about the markets having a 3 to 5% potential downdraft is a temporary thing. It's transitory. The underlying orthodoxy, as you say, is that not only is this administration closely attuned to the equity market and is going to act in support of it ultimately, and the central banks globally are accommodative. And so financial conditions, market sentiment is likely to rebound. There's going to be a buy the dip at some point, even if the negotiations go poorly, because there's so much demand. There's so much still dry powder across asset classes, in our opinion.
Constance, should that make me feel good or worried in this sense? The markets and the economy, demand doesn't seem able to support itself without the central bank coming back in on an emergency basis, whether it's the Fed or the ECB or whatever. At this stage in the recovery, shouldn't the demand take off on its own without the central banks having to be so accommodative?
Well, first of all, let's separate the ECB from the Fed, because we're in a very different situation here in the U.S. than we are in Europe. So the Fed was able to raise rates, right? And now okay,
good.
but off
We're
of the
2.5%. Wow,
well,
this is getting scary.
But you can't look at it.
But historically, that's a pretty low rate.
Well, yes, but I think what you can't look at it in absolute terms. You need to look at it in relative terms. So if we have 2% inflation and we have Fed funds at 2.5%, we have a positive interest rate, right, on the Fed funds. We are receiving positive interest rates in the market if you are a saver, and that is the important thing. Where is it relative to inflation and to the growth we're having?
Although I do have to wonder, this idea that both President Trump as well as the Federal Reserve willing to step in and support these markets, does that raise concerns about bubbles, about froth, about the idea that people
The Fed is not supporting the market.
Okay.
The Fed is supporting the economy. And when the Fed did its pause, it's because they made an assessment of what was going on with global liquidity conditions. Let's not forget, there were no high-yield bond issuances in December 2018, right? We had a severe tightening of liquidity conditions, not just in the U.S., but globally, and that is what the Fed responded to, along with other data coming in from Europe and China, that those economies were slowing down.
Mark?
Yeah, and as we've seen this week, the markets are wide open. Jumbo bond deals from large corporates, the high-yield market is open. Emerging markets are open. So I don't think a little pullback from a strong rally. NASDAQ was up 20% at the beginning of the week, year to date. A little pullback shouldn't be that worrisome. And so we're not overly concerned. We think that there's room for a little pullback, but then ultimately demand will come in as long as the economy, as Constance says, remains solid.